for raising that, for identifying that gap. I'm praising you for identifying that gap. But Chuk is a model student, by the way, because he's making a lot of extensive notes, and because he's making notes, he's generating questions. It's only in the process of making notes that you generate questions, okay, even about fundamentals, and that's how you get the questions clarified. So yesterday we had a long session after the class, which unfortunately I did not record. We should have actually recorded it. We had a revision on intrinsic value. So anyway, but we never managed to record it. So anyway, so where are we now? Here. All right. So, what is our topic today? Our topic today is, yeah. So we have completed the synthetic equivalent part. Okay. I don't know if 125 is too big. Let's see. We'll find out. Okay. I think 125 is a little too big. Let's do 120. Alright, so this last part, we have completed all the synthetic. I'll just mention a couple of points about this. Two things that you need to know, which you should know the terms. Okay, so if they ask you if you've covered options in detail. So options can be a module as well. When you're going for your interviews and people ask you, what have you studied? Okay, so I don't know if they've eliminated this. Anyway, so if they ask you in the interviews, what have you studied? Then you can mention options. In that case, you had better be completely fluent in all the concepts of options. Okay, so they may ask you what is covered call writing. So that question a couple of points we'll mention. It's there in your notes itself. Covered call, there's an expression, covered call writing. I can put it in inverted commas. Okay, covered call writing. If you come across this expression, what does it mean? It means exactly this. Can you see? Can you tell me? The answer is already on the screen. So what is covered call writing? One by one. Let Bharat answer. Give him the mic. No. You're just reading from the screen. I'm asking you this question. The answer is already given on the screen. What is covered call writing? So if I'm the interviewer and I'm asking you, you said I've studied options, and then I ask you what is covered call writing as an option strategy. What is your answer?
Long on underlining and
underlining
asset and short on the call.
Yeah, don't say short on the call, short call. Okay, long the underlying asset and short the call. Okay, so that's covered call writing. Here you can see the beauty of it. If you do the diagram on your own, okay, if you do the payoff diagram on your own, you'll see that in this what happens, long underlying and short call. So you can actually maybe sell the call a little bit after. I mean, suppose you're long the stock at 100, okay, and you can maybe if we go back to where we had those are actually quite a different chapter, but anyway, so if you go back, essentially what happens, so we're just trying to look at the I don't want to move away from this. I don't want to move away from that book, that page, because it will take a lot of. I have to go through a lot of pages. Okay, so the point is that if you go long the underlying, let's say you're long the underlying stock at 100, and you go short the call on the same underlying at say 120, which means from 100 to 120 you capture the profit. But if it goes above 120, then whatever you're making, you still have the long underlying, okay, but essentially it's getting all wiped out by the short call. So whatever excess gains there are over 120, that's getting taken out by the short call position, so that's getting neutralized. So you're capping your profit at $20, okay. So this is a strategy. This strategy is called, a lot of people do that because a lot of money managers, a lot of asset managers, as you know, are typically long only managers. Most of the mutual funds you see in India, okay, are mostly long. Most of the money is still being managed by the traditional asset management industry, which is on the long side only, okay, long only. So therefore these guys are typically long stock all the times, long stock, long bonds. So these guys, what they do is, against their long stock holdings, they will sell calls, okay, and then try to earn some income. Obviously if you go short the call, you can see here, if you are going short the call, if you're short call, obviously you will earn some premium. Yes. So they're using that premium income from the short call to sort of buttress their income. Okay, it increases their income. And sometimes if you're lucky, if you can sell a short dated call, typically when you're selling, you should be selling short dated calls. This is another thing we discussed yesterday. Okay. So so if you're selling call, you have a short dated call and you sell it sufficiently away from the market, and you're lucky it doesn't get exercised, then you get to pocket the premium, right? Whatever you made by selling the option expires worthless, and you get to pocket the premium. So it adds to your returns as an asset manager. Okay, so this is a common strategy. This is covered call writing. And the other strategy is what is called cash secured put writing. Okay, which is essentially here what you do. What do you think this means? Long on call. Don't say long on call, long calls. Cash secured put writing. What does this mean?
That we are going short on underlying asset.
Again, going short the underlying asset. Yeah, you can say short on the. It sounds a little odd if you say it was for the options. Short the underlying asset and short put. What happens if you go short the underlying asset? 1 minute. I think we should go back to that 12.2, maybe, because we are discussing too many of those. But anyway, no, I don't want to go back. We want to start on historical volatility today. But cash secured put writing is not. Cash secured put writing means that you write a put. Okay, you write a put, and let's just put this definition down here. Cash secured put writing. Let's put it here. It's within the brackets. Okay. Sell, put, and keep cash ready to buy if put exercised. Okay, so let's say the market is at $100 and you are ready to buy. Again, these are long only portfolio manager strategies. Okay, because these guys want to go long anyway. So if you look at this, so we can maybe look at some of this thing. Let's say this is the Dow. This is lots of upside on US stocks. Okay, you can see okay, yeah, so you can see here, let's say Netflix is having some problems. Okay, suppose you are willing to buy Netflix at say 240. If you're a money manager, you're generally bullish on Netflix and you think this is having some problems, and I'm quite happy to buy Netflix at 240. Okay, so what I can do in this situation is I can sell a 240 put. Okay, I can sell a 240 put because anyway I'm happy to be long Netflix at 240. So if the put gets exercised against me, then what will happen? I will be forced to buy Netflix at 240 because the owner of the put will exercise the option and sell me the put at 240, and the market might have dropped to 210, 215, whatever. But I said I'm already happy to be. Remember, these guys are mostly long only portfolio managers, so they often have large mark to market losses on their books, and they don't really care because they're really being evaluated against the market. Okay, so this is another topic which we have not discussed, which is the traditional asset management model versus the alternative asset management model. Typically, you'll notice your typical mutual fund managers like a Fidelity in the US or in India, if you look at HDFC mutual fund, they're actually benchmarking against the index. So if maybe their benchmarking is the BSE 200. So if the BSE 200 is down 15% and HDFC mutual fund is down 10%, they think they've done very well, because they are not concerned with absolute returns. They are concerned with beating the benchmark. The benchmark is down 15% and I am down only 10%, so I am a hero. This is clear. This is how the traditional asset management industry works. All the mutual funds that you look at, most mutual funds are like that. They are part of the traditional asset management industry. So they benchmark against a particular index, and so they are not really concerned with absolute returns. They are concerned with beating the index. So if the index goes up 15% and they have produced a return of 16%, they have done well because they have beaten the index. So they get evaluated based on beating the index. Okay, so this is the point. So that's why a lot of the times these portfolio managers don't really care, because if you look at it from an absolute return point of view, this can be quite a risky strategy of selling a put at 240, because if the market drops, already there are some fears now in the market about Netflix. Okay, because what is happening, lots of competition is coming into the streaming business. Everybody is launching a streaming offering. Okay, now so Disney is launching a streaming trading offering, which is, you know, Apple also. Apple's content is quite low actually. Apple's content is quite poor, but they have good distribution. Okay, but Disney has very strong content. So lots of people are launching. So lots of competition. People are getting worried about Netflix's margins and stuff. So therefore, it can be risky. So you sell the put at 240, and the market tanks and goes to 200, 160, then you're sitting on large losses because you're long at 240. The reason these guys don't care so much is because they are really not concerned with absolute losses. They are concerned with losses relative to the benchmark. So they will be benchmarking against, let's say, a mutual fund manager in the US will benchmark against the S&P 500. So they look at what is happening to the benchmark. So if the overall stock market is down and they're also down, it's not really that big a deal, as long as they're not down as much as the index. Okay, so therefore, just to give you the context as to why people follow these strategies. So cash secured put means essentially that you sell a put at 240, let's say, for example, and you keep the money ready. So if you've sold, let's say 100 put contracts, okay, so 100 put contracts at 240, if they get exercised against you, okay, how much money do you have to shell out? Because remember, when the put is exercised against you, that guy, the holder of the put, is selling you the stock. So if he's selling you the stock, what happens to your cash? It goes in or goes out? Cash has to go out because he's selling the stock, you're buying the stock. If you're buying the stock, means you have to shell out cash. So you got to keep that cash ready. Okay, so that's what is meant by cash secured put writing, which means the put writing, you can think of the put writing first. So you write the put, but the put liability on the put is secured by a cash balance which is kept in hand. So the cash balance is there with you, so therefore when it's secured by the cash balance, so if the put is exercised against you, you will lose, you have the cash ready to buy the stock. Is this clear?
Yes.
So these are two common strategies used by asset managers, which while discussing equivalence, we should discuss these 2 points. Sell put and keep cash ready to buy if put exercised against you. Okay, is this clear? All right, so now we can go on to our next topic. Any questions at this stage? So now we look at historical vol. Okay, let's look at this point here. Let's look at. Okay, so you see this. You have the link for this site. Okay, so here we're looking at the iVol page for Oracle. Okay, now notice that there is something called, we've already looked at these charts before. Okay, we've looked at these iVol charts. Here we've referred to, this is only for 1 year. Okay, so we have shown you in the past, we have only focused on the orange line, which is the iVol chart. Okay, but you notice also that there's something called a 30-day HV line. HV is the historical volatility. Okay, so from here onwards, I will now talk about, this is your note, these are your notes. Okay, so you have everything written here. So the expression that we are talking about here is basically historical volatility. Okay, so remember that here I've made a point. Okay, again, you'll not find this anywhere because I'm very particular about the use of words. Okay, it's historical, not historic. Okay, so in future I'm just going to say HVol because I don't want to keep repeating such a big word, historical volatility. But it's historical, not historic. Why am I saying that? Can anyone tell me what is the difference between this is an English language test. What is the difference between historic and historical? 1 minute. You give him the mic. This is also important because use of language is also important. You're MBA students, so your communication skills are important. Okay? Yeah. Yeah. So, what is the difference between historic and historical?
So, historical is adjective, it's actually complementing the word volatility. So, if I say historic, it's actually it's become a noun.
What? Historic is?
So, historical is adjective, so that's why you're just using the, so it's complementing the word volatility.
Okay, it qualifies the word volatility. But why not historic volatility? If I say historic volatility, what's the problem? Instead of saying historical, what is the problem if I say historic?
That's not the meaning.
That's not?
That's not the meaning.
Yeah, okay, so you're saying Pulkit is not correct. Okay, yeah, what is Tanya saying?
Sir, what I believe is So I believe that historic is like something that has happened in the past and doesn't change.
Okay, and historical?
Historical is like derived from past.
Okay, and what is hysterical? Hysterical, you know what?
Historical is
No, I'm just kidding.
change.
Okay, hysterical is not important. Okay, so please don't say hysterical volatility. Okay, so now, okay, let's not waste more time on this. You want to try? You want to try? Okay, what is this is the English language test.
So historic means that something very important has happened. For example, the independence was historical.
Okay.
Historical means that it relates to the history.
Okay, very good, very good. So you are basically 99% correct. Okay, so just phrasing could have been improved a little bit. So basically what we can say is all historics, let's do an English language lesson also here, and let's, because that's also important, your communication skills. Let's say all historical dates are not, let's make it necessarily historic. Okay, so we basically will say that, so we will just do this as English lesson once again, but okay, all historic dates are necessarily historical. Okay, why are we going to say so? Therefore, and we will also say, or a historic, because I want you to get used to this once again, repeating the same language. A historic date is a, what do we say? A contract is a species of agreement. Remember that?
Yes.
Contract is a species of agreement. So a historic date is a species of historical date. Okay, so people don't normally talk like this, but the statement is correct. Okay, why? So we understand, as Shuk correctly explained, okay, that why do we not want to say historical? Most people are not that particular, but we should be particular about the use of language. Okay, so historical dates, everything that is in the past is historical. Okay, everything that is in the past is historical, and as you correctly pointed out, but historic dates are of special significance. So 15th August 1947 is a historic date for India because it's our Independence Day basically. Okay, so that you understand now what it means. Historic dates are historical dates with some special significance. Okay, so that's why we don't want to use the word. So that's why we say that all historic dates are necessarily historical because they pertain to the past. Everything that pertains to the past is historical, but only the historic dates have a special significance. That's why we say that we can say, strictly speaking, like talking to a computer, okay, that a historic date is a species of historical date. This is clear? Because all historical dates are not necessarily historic, but all historic dates are necessarily historical because they pertain to the past. This is clear? So a little English language lesson, but also helps you to clear your concepts and how to use this word, how to use this expression. This so-and-so is a species of so-and-so. Okay, a contract is a species of agreement. Okay, so H-vol. How do we calculate H-vol? Now let's look at H-vol here. Alright, now we notice that there is also a 30-day H-vol chart. Okay, so that's the first thing. The other thing you notice when you look at this table, this is for Oracle, common stock of Oracle. Notice that the historical volatility figures, if you look at the current figures or the 1 week ago figures or the 1 month ago figures, you notice that the figures are different based on how many days you use. Okay, so this 10 days, 20 days, 30 days means that 10 days of data was used, 20 days of data was used, and 30 days of data was used. So using the previous 10 days of data, we got this. Using the previous 20 days, we got this. Then using previous 30 days, we got this. So you can see, just like you remember when you did your beta calculations in the CAPM, if you calculated beta using the last 1 year of data, and if you calculate that same company's beta using the last 20 years of data, you'll get a different number, right? Remember that? Yeah, so therefore this is basically what it's reflecting. It's reflecting the same kind of reality. Now the question is, what is this thing? What is this H fall that they are calculating and plotting against the I wall? Okay, you notice that there is a relationship here. Okay, this actually they should have plotted a lag value, but doesn't matter, they're calculating it. You see sometimes the I wall is above the H fall, sometimes the I wall is below the H fall. Okay, so let's see what is this H fall now. We have to understand what H fall is. Okay, as part of your options learning. This is your last topic in options. Okay, what is this H fall? How is it calculated? So H fall essentially is just the annualized. These are all expressed as annualized figures. Okay, just like when you're looking at a 3-month fixed deposit, it shows an interest rate of 6.25%. let's say that 6.25% is not that you're going to earn 6.25% for 3 months. It's an annualized figure. Everything is expressed as annualized figure. Similarly, these are all expressed as annualized figures. Okay, but this is calculated from 10 days, 20 days, 30 days of data, etc. Okay, so now let's look at how H fall is calculated. So there are certain assumptions here. Okay, so we are not going to go too deep into the assumptions of the Black-Scholes-Merton model. Okay, we can you can read about that this particular chapter 15 if you want, but essentially the idea is that the idea in the Black-Scholes-Merton model is that the infinitesimal means over a small period of time. Okay, infinitesimal means over a small period of time. We can actually, I have just taken out certain text from your textbook, which are parts of within chapter 5 itself, within chapter 15 itself. If you want further clarity, we can put it here and help you to understand. Okay, in case it may actually confuse you a little more, but the point is that the Black-Scholes-Merton model is the main option, the stock option pricing model. Okay, so some of the other models, if you want to be clear about, if they ask you in the interview. Okay, so Black-Scholes-Merton is actually the stock option pricing model. Let's also do a little bit of a session on, because some of these are typical interview questions. Okay, because they may not go that deep. Black-Scholes and Merton, BSM. Okay, so this is typically for equity options. Okay, equity options. Okay, let's put it this way. I mean, every time I don't want to write options. Okay, let's call this a small little bit of a diversion here. Common option models. Okay, so Black-Scholes-Merton is for equity. Okay, there is a binomial model, which is actually intuitively better. Okay, it's simpler. Binomial model can be used for equity options. In fact, it will converge to the Black-Scholes-Merton models. So I'm just going to write like this. You can also use it for other currencies, but mainly used for equity. Okay, possibly others. By others I mean other asset classes. Okay. So these I am writing all in your own notes. Okay, so this much you don't have to write, but this basically these, if they may ask you what are some common option pricing models. So Black-Scholes. Okay, then there is the Holy is some guy called Ho and some guy called Lee. They got together. Holy model is for interest rates. There's also another one. Who's that famous quant? Emmanuel Derman. Okay, yeah. So there is Holy model plus, let's say, Black. This Black is the same as the Black of the Black-Scholes. Okay, this is Black-Derman toy. Okay, Black-Derman toy model. These are for interest rates. Okay, so you see we are covering the different asset classes. So we got equity, got interest rates. Commodity options, you can use the binomial model as well. I'm not recalling offhand what are the special. We'll just do one more model, which is the Garman-Kohlhagen model. I hope I'm spelling this. Yeah, Kohlhagen. Okay, Garman-Kohlhagen model. This is for FX. Is okay if I write FX for currencies? Okay, so this will give you some basic. These are basically kind of superficial questions about options, but sometimes they may ask you in the interviews what are some option models. Okay, so these are some of the option models. These are just things to know. But right now we basically started with the Black-Scholes-Merton model, where for equity options. These are very unrealistic assumptions actually. But some of the assumptions, where is all this coming from? Here they are assuming that percentage changes of the stock price in a very short period of. That's why I said infinitesimal. Infinitesimal changes means changes over a very small, basically small changes. changes, okay, over a small period of time, short period, we are assuming that those percentage changes are normally distributed, okay. This is one of the assumptions, okay. And yeah, this is what does the volatility mean. We have already discussed this actually, that this is what is really important, okay. So the vol is basically the one standard deviation, okay, over one standard deviation annual movement, which we already discussed briefly when we were doing vol, okay. So the vol of when we are talking about the vol of a stock, so whether it's implied vol or whether it's H vol, both of them have this same meaning, that we are when we are talking about the vol of a stock, we are talking about the one standard deviation return, okay, over 1 year. That's what we are talking about. So all these figures, all of them are talking about the same thing. Estimated from 10 days of historical data, the H vol says the one standard deviation annualized return is 13%. From 30 days of data, it says it's 19.3. So you can see there are quite a dramatic difference between the two calculations. Where for the same stock, same underlying asset, but because the period of calculation is different, the data set is longer in one case, so you have a very different result, okay. Which all right. So this again should warn you once again about the transferability of assumption, the transferability of inferences from any kind of empirical testing based model. So if you do a model based, if you do a predictive model based on say last 20 years of data, and then you try to apply it to the future, but the future may not be like the past. So the behavior of the future, like remember I showed you that oil price chart, how dramatically, if you look at the long-term oil price chart, how dramatically oil price volatility has changed, okay. So therefore that is something that should warn you already, that depending on the data set that you're using, the results are different, okay. So that should be a warning on that front as well. But anyway, so far everyone is following. This is a little bit complicated, but we just have to understand the assumptions, and because we need to get a feel for how H vol is calculated. Essentially it is just what we are going to calculate. To keep it simple, it may look very complicated because there are complicated calculations and all that, natural logarithms and this and that, but is essentially what we are trying to do is we are trying to calculate the standard deviation of the period return, okay. We are going to calculate the return over a period first, and then obviously return is some series of figures, right? Over one period you got 25%, next period you got 35%, next period you got 45%, then you got minus 15%. These are all bunch of return numbers, and then we are just going to take the standard deviation of the return numbers, and we're going to use some examples from the assumptions about the behavior of the stock price, okay. So right here let's look at, okay, so let me just italicize this, so this is actually slightly outside the flow of this topic, okay. So we can actually put this outside the entire calculation so that we have a smoother flow here. Before we come to H vol, actually before, yeah, in fact let's put it right above this. So you have this common options, okay. Remember to return early, Garvit.
Yes, sir.
Don't go for a holiday. Okay. So infinitesimal percentage changes in asset price. Okay, here's another term that you need to know. What is the meaning of log normally distributed? Okay. Are you guys all familiar with natural logarithms?
Yes.
Everybody is familiar with natural logarithms?
Yes, sir.
Nobody has a problem? Gulati, you're okay with natural logarithms? Or you want artificial logarithms? You're okay. Okay, everybody's okay? Okay, fine. So then it's much easier. That's better, because your senior batch, many of them had, I don't know whether it's senior or super senior, many of them, there was a case where nobody had heard of natural logarithms or something like that. Some peculiar situation. One of your senior or super senior batches. Okay. So anyway, so what we are saying is that when we say that the stock price, you might hear this in the case of options, the option model essentially assumes that the stock price is log normally distributed. Okay, the stock price is log. Yeah.
I don't know what the natural.
Okay, so we'll just explain. You know what log base 10 is?
1.
No, but that is okay. But sorry, what I meant was that those are, I think, by John Napier, the Naperian logarithms. So log base 10. The concept, you know, what is log base 10? What is the logarithm? Log base 10 and log base e. The concept is the same. The base is different. That's all. Okay, we'll see. We'll just, it's just a way of expressing. Log is just a shorthand way of expressing a number. We'll see that. Okay, so we'll see. So what some of the expressions that you need to be comfortable with is that people will say that the stock price, the option models assume that the stock price is log normally distributed. Okay, so what are we going to establish? Basically, that we are assuming that the percentage changes in the stock price over a very short time are normally distributed. Okay, and we are saying that the stock price is log normally distributed. Basically what we are saying is that the percentage return, which we are going to use the logarithm, okay, which we can say here, essentially what we are doing is we are using the natural logarithm. Okay, we'll explain what that is, but we are basically, I just want to explain the steps overall first so that it's very clear. Okay, so we say that the stock price is log normally distributed. What does that mean? It means nothing but that the logarithm of the stock price changes. Okay, the logarithm of the stock price changes is normally distributed. That's why we say this. Is this clear? That the logarithm of the stock price is normally distributed. Okay, which is, let's say, let's write this as the logarithm of the stock price. Okay. Okay. Okay, you read your text, you read this chapter also, but this chapter is, it can get very confusing. That's why I'm setting up the overall steps clearly in your notes so that you can understand it a little better. Okay, so the statement we are making is that the stock price ST, the stock price is log normally distributed, which is nothing but saying that the log of the stock price is normally distributed. Okay, that's what we mean. And what is the log of the stock price? The log of the stock price, basically the price relative, the logarithm of price relatives, is basically giving you the continuously compounded return. Okay, so we use the log base E as giving you the natural logarithm is nothing but log base E. E, you remember what is the value of E approximately? 2.718, right? The Euler's constant, that E. Okay, so natural logarithm to the base of E is basically taken as giving you the continuously compounded return for a period. Okay, you'll see why, because e to the power x means if x is the rate of return, that will give you the continuously compounded rate of return. That's the assumption we make in finance. Okay, so far are you following? Please make sure you follow this, because otherwise you will get very confused. If you don't follow at any step, please ask me. Okay, so we are taking some assumptions. We are looking at the Black-Scholes-Merton model. Some of the assumptions, they are essentially assuming that percentage changes are normally distributed. Okay, and this percentage changes we are going to proxy it by the natural logarithm. Okay, so percentage changes are normally distributed is the assumption, and we are going to proxy the percentage changes by computing the natural logarithm. You'll see how. Okay, and therefore we are saying that is normally distributed. That's why we say the stock itself is log normally distributed. This is clear? Okay, so far, yeah. So now what we are going to do, look at this. Okay, so I put down the steps here, what they are doing. Now let's just look at this table 15.1. Okay, so this is what we are going to do. First, let's look at table 15.1. We are going to calculate historical volatility. First, look at this table. Okay, this is there in your textbook. The actual page number may be a little different. Okay, what are they doing here? They are basically taking a bunch of closing stock prices. Okay, you just get this from the historical database. You take a bunch of closing stock price. Now, what is price relative? No. Price relative, it's not the difference. Difference will be ST minus 1. It is a ratio. Okay. The price relative is always relative means it's a ratio. That's how we use the word term in finance. You've heard this term called terminal wealth relative. Wealth relative is nothing but I start with $100 and I finish with $125. Okay, so wealth relative, let me write this down also. That terminal wealth relative this is also an important point, important nomenclature which we should put somewhere else, maybe outside the historical vol calculation. Okay, let's use this term. This is an important point in finance. What is terminal wealth relative? Sounds like a very big term, okay? It's actually that very simple, okay? But this term is used in classical finance, so you should be familiar with this term. Terminal wealth relative, okay? Sometimes written as TWR, okay? What is it? Okay. I start with $100 at end of investing horizon. For this I would refer you to I don't remember the exact chapter for return computations, okay? Here's where your textbooks come in handy, okay? For return computations, there's a very good chapter, very beginning, I think right now at chapter 1 maybe. I'm just writing, okay? Chapter 1 I'm writing with a question mark. You just explore that. It's somewhere in the very beginning, okay? Maybe 1, maybe 2. Chapter 1 of your Bodica and Marcus, BKM, which is your IPM textbook, okay? They have a very nice chapter on all kinds of return computations, okay? This return, that return, geometric return, arithmetic return, period return, all kinds of, and then APR, those things. So as finance students, you should also be familiar, just like your NPV, your, that present value table and this and that, payment, those kind of problems that you came with, remember once? Those kind of annuity problems, annuity PVAF, those kind of complicated, those I think it's useful for finance students to also make sure that it's just mechanical calculations, but you just need to do them once so that you know what it is, and then if you need to revise, you can go back and see it from there, okay? So go back to that book and just see those calculations, okay? I'm just teaching you one part here which is important, which is a big word, terminal wealth relative. I start with $100 at end of investing horizon, okay? I have $135, okay? My TWR is what? Yeah, my TWR, not TWS, is 135 by 100. Terminal wealth relative. So the use of the word relative in finance is always, it applies a ratio, as I think Pulkit mentioned ratio, right? So that's what it means. So when we say price relatives, it is also ratio. That means ST plus 1 divided by ST. Yes, okay. So this is the term, this is the way you use the term. Yeah.
In IPM book, we'll find the calculation that how it become 135.
No. This I'm just telling you the fact. I made $35 of profit. So the terminal wealth relative has to start with these two numbers. You have to give the terminal wealth relative calculation. To do that calculation, you need to have these two numbers. So you need to know how much money you started with, and you need to know how much money you made in the end.
That will be the calculation now, how much money we have made in the end.
No. That is a fact. That is a fact. So you started, let's say 2 years ago, you started with $100.
Yes.
Okay. And after 2 years, you find that you have $135 because you made $35 of profit over 2 years.
Yes.
Now so this is an ex post calculation. You can also do it ex ante, but normally it's done ex post. So you know that after 2 years, you can see your P&L, you see that you have made $35 of profit. So after 2 years, your wealth is $135. You started with $100, now your wealth after 2 years is $135. So now you say that your terminal wealth relative is 135 by 100, okay? And the way you would calculate your, let's say the investing horizon in this case, if it is 2, okay, right? So let's say you can say 2 years or so. So this is basically what you have. This is the terminal wealth relative. Is this clear? That's what it means. This is a big word, but I just wanted to take off on the word relative because we are using price relatives in the HFOL calculation. This is clear?
Yes.
Right? Okay. All right. So, right, where are we now? Okay. So we are going back to the table. So is this clear now? You have a bunch of stock prices. That's very clear where it's coming from. You can just look at any data, okay, and take this bunch of stock prices. Then you compute the price relatives, which is very easy, which is just ST plus 1 divided by ST. Okay, here they have written it differently, ST divided by ST minus 1. Okay, So you've done that. Now all you're doing is you're taking to compute, see the daily return, they've written the daily return. What is this? This you know is the sign for natural logarithm. Okay, small l. What are they doing? They're just taking the natural logarithm of the price relative. Okay, basically this is meant to give you the continuously compounded return, because the return calculation comes from the price relative. Okay, so therefore here you are see, just because if at the end of 1 year you have $135 and you started with $100, okay, so you have made 35%. Okay, so that's where the return computation comes from the price relative. Okay, so these guys are doing the same thing. It's just that they take the price relative and then they take the natural logarithm of the price relative to use it as a proxy for the continuously compounded return. They assume that the return is continuously compounded because the natural logarithm is related to E. Natural logarithm is the log base E, right? So it is related to E. So this is an assumption we make, okay, that the natural logarithm gives you the continuously compounded rate of return. So it's clear? This is an assumption we are making. Okay, so now you have, so that's why they are calling this column the daily return. Is this clear? The continuously compounded daily return, because this is a day-to-day figure. This is day 1, day 2, day 3, day 4, and you're just seeing what is the price relative every day you're computing. Okay, the price relative, which means you're taking the return for every day. You compute the price relative and then you take the natural log of the price relative. So if you assume that the natural logarithm gives you the natural logarithm gives you the continuously compounded rate of return. Okay, so then you will get, when you take the price relative of the when you take the natural logarithm of the price relative, this is the return that you get. This is clear. Just like if you see here, let's say this was done for 1 year. Okay, what have you made on an annualized basis? Where are we now? Okay, how do we say here if we take this return? Okay, so what is 135 by 130? 135 by 100? 1.35. Okay, so how do you get to 35% annual return? Basically you are going to do -1, right? Then 1.35, you do 1.35 minus 1 to get the return. Okay, 1.35 minus 1 is equal to 0.35. That is equal to 35%. Can you see that? Right? So this is how you get the return, that you can see the relationship between the price relative of the terminal wealth relative. You can see the terminal wealth relative, and from there you can see how you compute the return. So 35%, okay, obviously visually you can see you have made 35%, but mathematically for a computer will not see visually, because computer can't see like that, like human beings. The computer has to be taught like this, that y is 135 divided, at the end of the year you have $135, beginning of the year you had $100, and therefore you have made 35% return for the year. How the computer will say how? So this is how you would explain it to a computer, that price relative minus 1, okay, that's your percentage return, 0.35, 35%, right? So the same thing now, instead of taking this 135 minus 1, we are taking the natural logarithm of this 1.35. We are taking the natural logarithm of this and we are assuming that the natural logarithm will give us the continuously compounded return for the period. Is this clear? So is everyone following so far?
Yes.
Okay, please make sure you follow all the steps. Gulati, are you following?
No, sir, I lost you at one point.
So you have lost me, so you have to tell me, when you lose me. Why am I looking at you and figuring out that you're lost in a trance? Yeah, where have you lost me?
1.35 minus 1 go to 0.35. After that I lost you.
So 1.35 minus 1. So what we are saying, what we are talking about here is that when we make $135, when we have $135 at the end of the year and we started the year with $100, it's very clear to us we have made 35%. But the computer doesn't understand it, that computer can't understand at this stage. To explain to the computer, you have to do 1.35 minus 1. That gives you 0.35 and that's 35%. That's why you have 35% as a return. Okay, so instead of doing that last computation, what we are saying is, now we will take this 1.35 terminal wealth relative if you take this, if it's 35%, let's do this calculation here. Let's open your calc file. Okay. We'll open a sheet for HVOL. So you can see that these return calculations can also be a little tricky. That's why you should go back to BKM, find that chapter where the return calculations are provided, first, second chapter of BKM, and practice it properly yourself. Okay, these are just calculated. There's no big deal. It's not like quantum physics or something. It's just something new that you have not seen. So you have to practice it for a few times to get the hang of it. Otherwise, the reasons why most of you are looking very lost about your concepts is you're not putting in enough work. You have to, these are all new things, so you have to wrestle with it for a little while until it becomes clear. These are new things which are quite detailed. There's a lot of material to be covered, lots of detail, small finer points here and there. So it's, unless you practice it several times, it will not get internalized. So you have to do that. Okay. So let's open a new sheet. I don't think we have a sheet here for vol. Yeah, so we don't have a sheet for vol. Let's open a sheet for vol. We'll just call it vol, may be confused for volatility, volume. Yeah, okay, right. So we'll do some calculations. So let's make the font really big so that everyone can see. This is actually 16 is not big enough, maybe. Let's make it 20. Okay. All right. Okay. So what were we doing? Yeah. Okay. Now what? 1.35 we can see is 35% because 1.35 minus 1. Okay. Now let's do this. Okay. Let's take 1.35. Okay. And let's take natural logarithm of this. So you can see that the continuously here, Gulati, again you're falling asleep. Are you not feeling well? You're falling asleep, I can see that. Are you not feeling well?
Yesterday I told you I'm having fever.
You never told me you have a fever. You said something is happening every day, something is coming up.
I also told you that I'm having fever.
No, 1 minute. Don't say I'm having fever, say I have a fever. Okay. So, I'm having means you say I'm having fun or something like that. Don't say. Okay, now what's the problem? One sec. Do you want to stay or do you want to go? No, I mean, are you comfortable?
Yes.
Okay, because I don't want to detain you. If you are not well, I don't want to detain you. You can go. I won't cut your attendance.
No, sir.
Okay. So if you feel, anybody feels unwell, okay, you're not feeling comfortable, just let me know and I'll let you go. I'm not going to cut your attendance. Okay? Okay? So yes, as soon as then Ritesh is not here, he'll get a headache. Yes, that day he got a headache for only lasted till the end of the class. After that he was back. Okay. So you can see that the continuously compounded return is actually lower than the flat return which we calculate, okay, which is the non-continuously compounded return. So we say that this, so you can see this figure is still somewhere near that figure, 35%. So this is how you get to this. This is what we assume, that the natural logarithm gives you the continuously compounded rate of return. Okay. So now let's look at one more thing, which let's clear up the natural logarithm part for Chug, let's say. Okay. Let's do one thing. What are the figures? Let's take one of the figures. What does this mean actually? Okay. So we are saying, you see this 1005, okay, that is coming just from dividing 20.1 by 20. Okay, now 1005, they are saying that the natural log of 1005 is giving you this 0.00499. okay, so let's see that. Okay, let's test it ourselves. 1005. No, let's do it stepwise so that everyone is clear. So what we'll do is we'll take natural logarithm of we are getting this Is this okay? We got the same number, 0.00499. This calculation is correct. Okay. Now let's see what this means. Essentially, what does natural logarithm means? So if natural logarithm of 1005 is giving us 0.00499, who wants to tell us how can we express this now using E? E, let's put, we are not going to write, E is roughly say 2.718, okay, but we will use the E formula here because we want to make sure that they calculate exactly, okay, so roughly equal to 2.718. So what this means, let's write it here. So if we are taking natural logarithm of this, of 1005, we are taking natural logarithm of this and getting this result, okay. This means, and this is the same for log, the concept is the same for log base 10 also. If I take a log of something, okay, let's say if I take log of x, okay, if I take log of x, in this case we are talking about log base E, okay, if I take log of x and I get a result y, okay, that means that if I raise y to the power, if I raise the base to the power of y, I should get back this number. That is all that log is, and you can change the logs. Okay, 1 minute, let's see it. You saw what happened?
Yes.
We saw this figure 1005. Yes. We took the natural logarithm of this, okay, and this basic logic we are explaining is applicable to log base 10 also. It's the same logic, it's just the base is different. So log base 10, instead of this we will write 10, okay. So now if I have this and I take the natural logarithm of this, I end up with this result, okay. So this is like, let's say this is equal to x, if this is x, okay, maybe we should just put a little, alright, okay, so we say x is equal to this and let's say y is equal to this, alright. So what we are saying is that what we can see firsthand is, if when we take the natural logarithm of this, when we take the natural logarithm of x, we get y, right? When we take the natural logarithm of x, we get y. So we can write ln x is equal to y, okay. So now that ln is to the base of e, which is approximately 2.718, okay. So what this means also is that essentially if we are taking a natural ln of x and getting y, that means if we take, and we have to remember what that log is to the base of what, okay. So the base, so basically what this means, that if we raise the y, if we raise the base to the power of y, that will become equal to x. Just again, those who are not clear, please practice a little. It's nothing very complicated, it's just something new if you're not used to it or you've forgotten it. So you just practice it a few times, then it will become clear, okay. But without practice, then nothing will be gained. Practice makes perfect, you remember that, right? Ganotra, are you following?
Yes, sir.
Yeah? Okay. So, okay.
Are you well?
Okay, so is this clear now? Once again, let's repeat that once again. So if I'm taking the natural logarithm of x and I'm finding that the answer is y. Now natural logarithm is to the base of e, approximately this. So if this is what I'm getting, then it must be true that if I take the base and raise it to the power of y, I should get back to x.
Yes, sir.
Is everyone clear now? Let's do that. Okay. So what we are going to do now is we are going to raise it back exp, okay, Euler's number, okay, approximately 2.78 raised to the power. Now what are we going to do? We are going to raise it to what?
0.04190.
We are going to raise it here and let's see what happens. We are getting on point, we're very happy. Okay, so Shubh, are you paying attention? You are not paying attention. This was done for you. You are not, you are looking down like this. Is this clear? Now it is clear now?
X will return back to the original.
Okay. I hope that this is all being recorded, yeah. Okay. So,
You get no views.
no, not a big view. I'm concerned about him. Because when we did it, you were looking down like this. So is this clear? What did we do? We saw that natural logarithm of x is giving us y. So we found out what is the natural logarithm base, it's e. So then what we do is we raise the base to the power of y. We raise the base to the power of y and then we should get back to x. We got that clear? We have raised this base to the power of y. This is clear? Everyone is clear about this now? Anybody who had any doubts? Okay. So that's all we are saying is that the natural logarithm is being used as a proxy for the continuously compounded rate of return. Similarly, you will see, yeah. 1 minute, quiet, give him the mic. We need to have fast mic relay, yeah.
Which one of these values actually?
1 minute, be quiet. Be quiet, please, yeah.
So which one of these values representing the final return?
Which values?
The 1.05 or 0.499?
No, 0.00499 is the continuously compounded return because it is the natural logarithm of that. So we are taking, see, once again, let's go back to the, now that we have seen this exercise, let's go back to this table. Okay. So where are they saying daily return? They are not saying daily return over here. They are not saying daily return in the third column. They are saying daily return in the fourth column, because the fourth column gives you the natural logarithm of the price relative. You saw that when we compute our normal return of 35%, we do that 1.35 minus 1 to get 135, to get 0.35. But in this case, we don't do that minus 1 part, we do the natural logarithm to proxy the continuously compounded return. So the return is basically in your fourth column. Is this clear? That's why they are writing this is the proxy for the daily return. Is this clear so far? Yes. Okay. Alright, so you need to understand we're doing this calculation because you need to be very clear about HFOL and where it's coming from. Okay. As part of your learning basic knowledge of options, you need to know how HFOL is calculated. You need to have a feel for it. So all you can see here is not very complicated. You just take a series of stock prices, take the price relatives, then take a natural logarithm of the price relatives. That gives you a proxy for the return. Now all we are going to do is we are going to take you have taken standard deviation of other series. We are just going to take the sample SD. We are going to use the sample SD formula, okay, as an estimate of the population SD, unbiased estimate. Okay, so we will have n minus 1 in the, you remember that, n minus 1 in the denominator. So you will have n minus 1 in the denominator, and we will just compute the sample SD of this as a the population SD estimate, okay, of this last column, the fourth column, which is what you see here. Okay, now we are going back. Now let's look at this. Okay, you should also read this box, this mutual fund returns. You should read this box because it is quite simple actually, but it talks about geometric return versus arithmetic return. You should also cover this box. Okay. Okay, now we are going back. Now you're already familiar with the table. This here we are trying to this is covering that same exercise. Okay, so only thing we have to remember is this t that we are talking about. This t will be written as a fraction of a year. So if it is 1 year, if you're using 1 year of data, then you'll write it as 1. But if you're using like annual data, okay, but if you're using daily data, you have to take, we assume the 252 trading days, sometimes 250 days, okay, because markets are closed on Saturday, Sunday, so 52 weeks out, 104 days, okay, then balance about 10-15 holidays, leave out 10-15 holidays, so you have about 250 odd trading days. Okay, so if you are using daily data, then you have to use 1 by 252 or 1 by 250 roughly. Okay, so the time is shown as a fraction of a year basically. The time period for the data series, like if you show here, where am I talking about this? No, yeah, I'm talking about I want to go back to the table. Yeah, so here this is daily data. This is daily data. So the t that we are going to use for this daily data is, we have to write this t as 1 by 252. Okay, we have to talk about this period in terms of a fraction of a year. So if we are using annual data, we will just write 1. That is basically just 1. But since we are using daily data, we have to then think about how many days are in a year. 250 days, let's say. Okay, 250 days. So then we have to write this t as 1 by 250. Okay, is this clear? Okay, so 1 by 250 because Year can be represented by days as writing 250 by writing 250. If you want to represent a 1 year time period, you can write that as by 250 days. But you're taking only 1 day's day-to-day data, so you have to write 1 by 250. Okay, you'll see this. Okay, later on. All right. No, this is further down. We have to go back. So you see this because I'm trying to explain all this calculation here. Okay. You see what he's doing here. Maybe we should just look at the steps once in your notes. Okay. So far everyone is following? Okay. What are our steps? We have gone through all this stuff. Okay. Collect data series daily, weekly, table 15.1. Okay. Collect data series. Compute price relatives. You have seen that. Take natural log of price relative. This is giving us our series UI. Okay. So this is giving us our series UI, which is basically the continuously compounded return for the period. So far everyone is following? This is the last column in the table. That last column in the table, we are calling it a series of UIs. Okay. So we will now take the standard deviation of that. Okay. Time is, this is what I just discussed right now. Okay. T is equal to here 252, 250, 252. Okay. So we have to write increment in years. Okay. The length of the period. Okay. Where have I mentioned period? Here. This period and this period is the same. Okay. So if I'm using weekly, what will happen to my T? If I'm using weekly data, 1 by 52, correct. Is this clear? So if I'm using if I'm using weekly data, then I should write 1 by 52. Is this clear? Instead of this T will have to be written as 1 by 52. Okay. But generally you should try to use not longer than daily data. Okay. Not something of a greater frequency than 1 day. Okay. Because we are talking about instantaneous rate of return, so the shorter the period that you use is better. Like hourly data is even better, that kind of thing. So anyway, so we have got this far, this now here. Now you know how this T is written. Now we are going to calculate this sample SD. Okay, so here you can see from the series UI, which is nothing but the last column in our table, which we saw. Okay, so here you see the calculation for that. This is basically already giving you the natural, this UI is being defined as the natural logarithm of the price relative. You can see it here. Okay, can defined as the natural logarithm of the price relative. So here they are doing the estimate of the standard deviation of the UIs. Okay, so there are some calculations. You can expand this and see. You can see this 1 by n minus 1. So unbiased estimate of the population SD. So you can see these are just opening up brackets and things like that. Just multiplying opening brackets. You can do this calculation yourself if you want to play with it. But essentially what it does is you get this, that from they are referring to a previous equation. Okay, so you get an estimate, okay, of S, okay, which is like this. This is the estimate, the final form of S. Then you open it up later on. Okay, so but this is an estimate of the population SD, which is basically from a previous equation. We are not going to get into why the population SD is a sigma root of T, because that we don't need to get into that. Okay, yeah. So this is an estimate of this. Now follow the logic here. Okay. So this S is an estimate of this. Now, are you familiar with this hat notation? When you did regression and all that, did you come across the hat notation? Beta hat. Estimate of beta is normally in econometrics. When we are doing an estimate, when we are estimating beta, we write it, if there is an estimate of beta, we write it as beta hat. You familiar with that hat concept?
Yes.
Okay. So this is basically 1 minute. So what we are doing is we are trying to the S here, which is the standard deviation of the UIs, okay, which is an estimate of sigma root of T, which is the standard deviation of the standard deviation of the UI, the population SD. Okay, it's an estimate of the sigma root of T. So therefore, basically, since roughly approximately S is equal to sigma root of T, if you take this equation, as if you take this as the estimate, so you write the sigma hat is obviously equal to S by root of T. Is this clear? This is simple juxtaposition. This is clear. If S is an approximate estimate of sigma root of T, where the sigma will be written as a hat because it's an estimate. Okay, so S is approximating the sigma root of T. Therefore, sigma is equal to S by root of T, and then we write that sigma as sigma hat because it's an estimate of the population. Is so far you're clear? Okay, is everyone clear? All right. So we come to this is basically what we need, that's all that we need, okay. We are going to estimate the sigma hat, then we are going to say that this sigma hat is the H wall, essentially. This sigma hat will become the H wall of the underlying asset, that stock price which we started with in the second column, okay. All those stock prices for day 1, day 2, day 3, day 4, that stock price, the H wall of that stock price will become this sigma hat. Is this clear? Okay, so now you see what happens. Now these guys are referring to 15.1, the table 15.1, which you have already seen. So all they are doing here is that they are breaking up this S estimate, okay. They are breaking up the S estimate and coming out with a S value of this. Okay, so this is just the computation of each of the parts, and then they are coming out with this value of 0.01216, which is 1.216%, right? Is everyone following so far? If you don't follow at any point, you must ask, otherwise you will get confused. The reason, anyway, this calculation is a little confusing, and I think they have not they have written it with, I think basically it doesn't seem to be very smoothly, the logic is not flowing smoothly for people who are new to options. So I've tried to make it little, I've tried to give you some stepwise analysis so that you understand it a little better when you read the chapter, okay. So essentially what you have, so is everyone clear so far up to 1.216? This is nothing but the same thing, that formula that we saw there, above there. This one is just broken up, opened up. Sorry?
Why there is 20 into 19?
Where is 20 into 19? N into n minus 1, that is there. N into n minus 1, okay. Okay, so you get this final result of the S, which is 1.216. But what did we say? We are not interested in S, we are interested in sigma hat. Sigma hat is S by root of T. Are you following so far?
Yes, sir.
Our S has come out to, from 15.1, S comes out to 1.216. Yes, Gulati, are you following? You are immersed in some other book. Please make sure you understand what is going on, okay? Otherwise there will be a problem. Okay, so 1.216, everyone is clear? This is our S, okay, from that table. We just applied that formula which you see on the top of this page. This formula, we have just applied it to the data in the table 15.1, which you already looked at. That gives you an S of 1.012 whatever, okay, 1.216%, 1.22%. But we are not interested in S. S is not our estimate of what, S is not our Vol estimate, okay. The Vol estimate is sigma hat, which is S divided by root of T. Yes? Are you following so far?
Yes.
S divided by root of T. Now, here again, I feel they should have shown, if you're writing a text, I think they should have shown the step, just all the baby steps should be shown. S, now what they are doing is, they are multiplying, you see what they are doing? Multiplying 1.216 by root of 252. Why? Actually, one intermediate step should have been shown. This is S 1.216. You are interested in S divided by root of T because you are interested in sigma hat. You are interested in sigma hat,
yes,
which is your Vol. So you want S divided by root of T. So one intermediate step should have been shown here. S is this, S divided by root of T, and what is T? T itself is 1 by 252. So S divided by root of T, but T itself is 1 by 252. So actually it is S divided by root of 1 multiplied by root of 252. Because T itself is 1 by 252, right?
Sir, divided by root of 1 by 2.
Let me see. One minute. Is this better? Let's say, one sec. You are dividing something by, you are dividing the S by root of T. Okay. So T itself is 1 by 252.
Root of 1 by 2.
Yeah. So root of 1 by 252, I'm breaking it up further into baby steps. Okay. So you are basically, it is root of 1. Okay. I mean, which is basically 1. So that's why the 252 goes to the top. Okay. That's why, because what is he doing? He is multiplying it by 252. Is this clear? Are you following so far? Okay. So he's multiplying by 252. Okay. So therefore now that's why you get this. Root 1 is 1. 100 divided by 1 is 100. Okay. So is this clear now? Has everyone followed? Anjum, are you following the steps? Yeah? Okay. So now you understand why S is being multiplied, S which is 1.216 is being multiplied by S is 1.256 is being multiplied by root of 252. Is everyone clear why it's happening? Okay, because the 252 goes to the root of 252 goes to the top. Okay, all right. So then you get 19.3. That's your ball. Okay, basically this is how, so you needed to have a feel of how h-ball is calculated. Okay, and you should also be clear about the steps, because having done basic options, you should know always what exactly. You can always refer to the textbook for a formula or something like that, but you should have a broad idea as to how essentially you it's basically the standard deviation. It's going to come from the standard deviation of the price relatives of the continuously compounded return. It's going to come from the standard deviation of the continuously compounded return, which is your last column in this table, the natural logarithms, which give you a proxy for the continuously compounded return. You're computing the standard deviation and then you're just adjusting it by the time factor. Okay, you're just, in this case you mechanically remember, but when you know the derivation comes, actually it is divided by root of t, but t is expressed like this. So eventually you end up, when you see in many books actually they may just write it directly like that without showing the steps, and like this guy also has actually not written, he should have written actually baby steps, because in a textbook I think you should write baby steps. So it will just be written as, if you are using weekly data, the books will just say, okay, your standard deviation from the sample is coming out as 1.216, then you just multiply 1.216 by root of 52. Are you following? That is what they are going to do in the text, in many of the books. They will say that you have this data set, and then you will compute the price relatives, the natural logarithms, okay, and then from that whatever the standard deviation of that series comes out to, you will just multiply. If you were using weekly data, you will just multiply it by root of 52. If you were using monthly data, you will multiply it by root of 12. Are you following? Because in monthly data you would have written your t as 1 by 12. In weekly data you write your t as 1 by 52. Yes? Shivam is falling asleep. Okay. So you have to go and revise this. You have to go and revise this on your own, because it's a complicated set of steps, a lot of detail involved, and you're seeing it for the first time, but there's there's no rocket science here. Okay. Therefore, yeah.
In this trading data 252, so if we calculate...
One way, use the mic. Yeah, okay. Although you're here, but give her the mic. Your voice is anyway quite soft. Yeah. Trading days are 252. Yeah.
Per year. So if we calculate the weeks according to the days per year, so then it won't be 52. If we
Yeah. But we are not. That's not the convention that we are. I understand your point.
Yes.
You're saying basically that you should take it as 252 divided by 5 or something like that. Okay. So yeah, you have a point there. That kind of point is addressed later. Trading days versus calendar days. What causes volatility? So there is no clear-cut answer on either side. Okay, it's not like if you use that method, people can say that you're wrong. Okay, so there is no clear-cut. Depends on whether you want to calculate trading days or you want to calculate. Should you calculate weekends? Okay, so but you're right in pointing out that there is a little inconsistency there, because on the one hand we are using trading days for daily data, and on the other hand for weeks we are just taking 52. But that is the convention that the market uses. Okay, but but it's not a very satisfactory set of assumptions. They're not really consistent with each other. So you're right. But there is this debate about whether we should use trading days or calendar days. Okay. So anyway, so it's always better to use daily data. According to me, one should not be using data for a period longer than 1 day. Okay. So, but the idea is, the reason I mentioned weekly is basically just to give you the comparison that because T is written as 1 by 252, and so what you'll see in many of the books, maybe even in the Nattenberg book, if you look at H-wall calculation, he will just say you compute the standard deviation, the sample SD, you compute the sample SD, and then you just multiply the sample SD is here. You just multiply the sample SD by the root of whatever. If you use daily data, 1 by 250. If you use weekly data, 1 by 52. If you use monthly data, 1 by 12. That's how they'll write it. Okay. But these are the steps through which this is coming out. Is this clear? Other steps, hopefully the steps are clear. Here I've tried to explain everything here. Okay. That sample SD S calculated from series. True population SD is sigma into this. This is just already there in your book. Okay, so this is there. Sample SD is this. I've given you the explanation of this table 15.1. Okay, these page numbers may not match exactly. Okay, so population SD estimate, and you can see into root of 252. Okay, and then 19.3. All right. So this is what it is. That sigma hat is what we call the H-wall. So all these numbers that you see, all these, when you go back to this, when you go back to these kind of tables, and you see that Oracle H-wall is 13%, okay, 17%, 19%. This is because here for 13% they used only 10 days of data. Just like in this table 15.1, they have used 20 days of data. Okay, if you don't use those 20 days, in fact, if you jump back 20 days and use the last 20 days before that, basically the first part of the last 40 days, if you do that, then you'll get another different set of numbers. That will also be 20-day calculation, but it will be a different set of figures. Okay, because you have gone back 20 days and looked at the previous 20 days. So it's like the first part of the previous 40 days, first half of that. So 10 days of data, you got this number. 20 days of data, you got this number. 30 days of data, you got this number. All using Oracle stock price data. Same, these things have come out of the same process. All they did was they took the data, 30 days, if you take 19.3, 19.4, they took the data, they took the stock prices, they created the next column for price relatives, they took the natural logarithms, they took the standard deviation of the natural logarithms, and then they multiplied it by the root of 252 or root of 250. These guys may be using we don't really know. You have to look at the software, what kind of assumptions. They may use 250, some people use 252. Okay, so that's how it, but the point is that that's how this number came out. Are you following? Okay, the numbers are all different because obviously the stock prices are different on the different days, and then obviously the changes are also different. Okay, so this shows you the basic instability of the market. Okay, one more thing here which we can look at. Okay, we have a couple of minutes. Okay, so now what's I-wall in your, again, page numbers may not be exact, 15.11. This part we have already covered actually, but I'll just mention there's a brief mention of I-wall here. This is what happens every time I jump. Okay, so remember this exercise we have already done, but you can just read about the I-wall in your, I've given you the section reference. Okay, this we have already done, so there's nothing really to tell you here. That how we calculate H-wall, okay, how we calculate I-wall. That we look at the option price, we randomly put in some vol input in our option pricing model. Okay, we randomly put in some vol input in our option pricing, option valuation model, and we find that the call option price is 3.019, but we look at the market price for the same option and we find it's maybe 4.5. Okay, so we have to keep on increasing the vol input and until we have a model output which is equal to the market price of 4.5. And whatever that vol input is, you keep on increasing, and then you end up with this 4.5. And the other thing to remember, of course, is that here so you can read about this. You can read this section. Basically, he will also tell you that this cannot be analytically computed. Okay, so remember, there is no analytic solution. To use the language of mathematics, there is no analytic solution here. It has to be iteratively approximated. And what is the other famous variable that you guys have encountered that Tanya should not answer, because Tanya has answered it before? What is the other variable? This I-vol, we told you we cannot analytically compute the I-vol. IRR, okay? So IRR is the other variable. So analytic solution is something like this. When you did this, understand, maybe we should also mention it one more time.
Yes.
Okay. 1 minute. Anyway, so what we were saying is that when we wrote this kind of thing, that when we wrote that the sigma, the S is approximately equal to sigma times root of t. Therefore, the sigma hat is S by root of t. These are called analytic solutions. Okay, A is equal to B into X. Okay, therefore B is equal to A divided by X. These are analytic solutions. Okay, for B. But in I-vol you can't have an analytic solution, just like in IRR you can't have an analytic solution. These are derived by what is called iterative approximation. So you should know these terms also, and you should know that I-vol and IRR both are only computed by iterative approximation. Is this clear? Okay, everyone is clear?
Yes, sir.
Garvit is happy? 1 minute 30 seconds. Okay. Yeah, what is your question? Why is it not working? Okay, never mind. Ask the question.
I'm asking what is the importance of historical model? Why do we find it out? Because if we are doing trading in options with the help of implied volatility, because that's important, or we have to do the market fluctuation, then why historical volatility?
Okay,
Because
good, very good question.
price changes every day. So historical data would be that significant.
Yeah, okay, so your question is very important. Actually, this is leading you to one topic which I was not planning to cover. Okay, so this essentially what you're asking is why do we bother with the H-vol price? The reason we bother is that the I-vol that is coming out of the market prices, that is actually a forecast for the future H-vol. Okay, so as an option trader, so from your perspective, because you have been asked to trade options like a speculator, not as a market maker. Okay, so when you're trading options as a market maker, that is a slightly more complicated state of affairs. It has all the complications of what you're doing, but it has some additional complications which relate to the hedging of these things like Vega and these things like gamma, delta, gamma hedging. Okay, these things are related. So this hedging of delta and gamma is very related to. You can see that the H-vol, obviously you can see how it's calculated. So it depends on how much variation there is in the stock price. That will affect the H-vol calculation, how dramatically the stock price moves around, right? So that dramatic movement in the stock price has a huge impact on what is happening to the gamma exposure of the stock, of the option portfolio. So when a market maker is making markets in options, he will have a whole bunch of options, and he will be looking at a portfolio gamma and delta, and those the gamma especially is very affected by how dramatically the stock is moving. If it's not moving, it has a very different implication. If it's moving dramatically, it is very different. So the degree of movement has a big impact, okay, on his profitability. Okay, so that's why, and that is going to get reflected. If it's moving around a lot, it will reflect in the H-vol calculation, which you'll do later, right? Because the data is changing. So that's why, and actually what this is, your question is anticipating that point which is not mentioned in any textbook. Okay, but I'll briefly mention it here, which is that what is the I-vol? You have now seen how H-vol is calculated. Okay, guys, one sec. So the question that Salonia has asked is actually a very important question. 1 minute. The question that Salonia has asked is a very important question. So in answering her, please make sure you listen to the last part of the video after the class is over, because this is a part which is a module which is there only in my notes. You will not find this in any book. It deals with the question of, I suggest all of you sit and listen to it. Okay, I'm eating into your lunch. Okay, doesn't matter. It will spice up your lunch. Okay, so the question is very, very, very good question. Why bother with H-vol? Okay, so I've given us some of the answers. You can listen to into that, okay, because it has the H fall reflects the degree of movement in the market price. Obviously, it will affect the H fall calculation, okay. And what is this so therefore the market maker's perspective, okay, listen to the video, the last part what I've explained to her. But basically this leads to the important question of, which you will not find mentioned in any book, what exactly, this is your second intuitive answer to I vol, which I will now copy from here and give you, since we are discussing this, even though what is the meaning of I vol? So she has actually led us to this discussion. So since she has asked the question, I'll discuss it, okay, which is your next subtopic, okay, which becomes your next subtopic. We have done two discussions of I vol, meaning shut the door. One mechanical answer, which is the iterative approximation, okay. One is the intuitive, it's an index of option prices. Second intuitive meaning of, listen, pay attention. Second, very important. You have to understand what is I vol. When the market says, okay, let's say the I vol is 42.4, okay, or let's say here, for instance, what is implied vol? IV index mean for Oracle options is, let's say, 16.4. What does it really mean? Let's say this is a 30-day I vol mean, okay. So let's say this IV index is computed for 30-day options, okay. This is IV index for 30 days. Now what does it actually mean? This I vol is coming out of market prices. Let's say there was only one option, let's say for Oracle in the market. We got this I vol figure of 16.4 by looking at their option price and continuously adjusting the vol input in the vol model in the OVM to make sure that the model output price is the same as the market price. So what does that mean when the market price of Oracle options is giving us an I vol of 16.4, 30-day options, okay? You have to know what tenor of options. It means basically that the market is saying that, 1 minute, listen, it's very important, that if you jump forward, if you get on a time machine and you jump forward 30 days and then you look back at the previous 30 days of data, okay, and then you do a H vol calculation, that figure will be 16.4. That's what the market price is saying. It may not actually be. But what is the meaning of the second intuitive meaning of 16.4? This becomes more important for a market maker's perspective, which you have not been exposed to in your project. You're trading like a speculator. For a market maker, this becomes very important. This goes to the heart of the question that she asked. Okay, why bother with H vol? This is basically the I vol is the market's forecast for the future H vol. So 16.4 I vol today for 30-day options means if you jump forward 30 days and then look back 30 days and compute the H vol, that figure will be 16.4 according to today's option prices. So what a market maker will do, let's deal with this situation anyway since we have got into this topic. What is a market maker? Why is H vol very important for a market maker? Because the market maker will take a view on how the H vol will actually transpire in the next 30 days, and he will form a view. He will look at the H vol chart, he will look at this blue H vol chart, and he will say, no, this next 30 days, just shut it. You can come in and shut it, but just shut it, okay? So what is the market maker going to do? He is going to look at the option I vol of 16.4% and he's going to take a view of the H vol chart, and he will say this 16.4%, let's say he has a very bullish view on H vol. Just shut the door. You can come in, but shut the door, okay? Are you following? Yes, sir. The market maker will now, he can see clearly the market is forecasting that 30-day H vol 30 days from today will be 16.4. Market maker looks at the H vol chart and he forms a very bullish view and he says, no, I think H vol after 30 days, H vol is going to become actually 45. Okay, not 16.4, but I'm just giving an arbitrary number. Let's say it's 45. So then what he says is the option market is underpricing the H vol. So he will buy options. He will become a net buyer of options and he will hedge in the market. He will do delta and gamma hedging, which we haven't got into, which is complicated. But this is why H vol is important. Okay, so the market maker and reverse, if he feels that next 30 days H vol will actually end up computing at maybe 5%, not 16.5%, then he'll become a seller of options. He will have a selling bias for options because he's saying option market is overestimating the H vol coming for the coming 30 days. This is clear? That's why you need this. So we have eventually got into this discussion of the market makers person, the second intuitive meaning. Very important because you won't find this in any textbook. Not even in the Nattenberg book. It's not explained by what does it actually mean when the market gives it at 16.4. Is this clear?
Yes, sir.
Okay? Alright? Okay, good. So congratulations to Saloni for a great question. Good. It is already recorded.